Hello, everyone. Thank you for joining today's webinar. So today we're going to talk about AGIX, the road to AGI, and the investment opportunity behind AI ecosystem. My name is Derek Yan, Senior Investment Strategist with CreenShares. So just before the discussion today, I want to remind you, if you have any question during the discussion, please send your question to a Q&A session in the Zoom, if you're joining with Zoom, or if you watch through CreenShares.com, please submit your question at info@CreenShares.com. For investors who want the C credit, we offer 1 C credit for the CFP and CIMA. Please email ce@CreenShares.com to get your C credit. So artificial intelligence has been at the forefront of equity investment over the last 2 years, right? So AI companies have delivered strong performance since the launch of ChatGPT. With the recent correction in the equity market, many investors are wondering, is the AI thesis still valid on the long term? Like, how should we think about the current AI development? And can this company generate substantial returns on the massive investment? And how should you capture the AI opportunities at the current stage? So today, we have invited 2 honored guests from our partner, Atna Capital Management, Solomon Beer and Max Chen. So Atna is an investment management firm specializing in artificial intelligence ventures. Established by AI native investors and engineers, Atna's research leverages deep technical expertise and extensive network to identify and support groundbreaking AI companies. Its portfolio companies include well-known AI platforms such as Anthropic, xAI, and Perplexity. Atna is a partner with CreenShares in the artificial intelligence investment, and it has powered the AI score for the AGIX index. So Solomon Beer is a partner and portfolio manager at Atna. So brings extensive experience in the artificial intelligence industry. He previously held a founding role at Cruise Automation, where he was granted 7 patents in machine learning, AI, and computer vision technologies. He currently serves on Atna's investment committee, and he holds a bachelor's degree from the University of Southern California. Max Chen is an executive director and portfolio manager at Atna. Max is also a member of Atna's investment committee. Prior to joining Atna, Max has worked for many leading institutions, including Ping An Asset Management Hong Kong, KPMG, and Sequoia Capital. Max held an MBA from Cornell University and a master's degree from the KU Leuven in Belgium. So thank you for joining us today, Max and Sol. Going to the next slide, I'm going to give you a brief introduction of CreenShares for those who don't familiar with CreenShares. So we are a New York-based ETF manager, founded in 2013, with the total asset under management about $8 billion. Going to the next slide, you can see some of our flagship ETF focus on China, climate, uncorrelated assets, and global themes. We aim to offer investors innovative solutions to capture the investment opportunity of the mega trend in the world today. All right, going to the next slide, you can see that recently we launched AGIX, right? It's CreenShares AI and Tech ETF. The fund tracks selected Atna AGI index for its public equity exposure. With Atna's proprietary AI score, the index is designed to provide AI basket that capture the whole AI ecosystem, from AI hardware, AI infrastructure, to AI applications, right? And the fund can potentially invest about 10% into the private AI companies as well, such as Anthropic, xAI, and Perplexity, as I mentioned. Actually, I wonder how AI would introduce this ETF. So let's see what happens if I'm gonna use the platform like Perplexity to show you how this AI native app would introduce this fund. So let me share my screen. So as you can see, this is Perplexity's interface. Compared to like traditional search engine, you just ask the question like, what is AGIX ETF? you can see that instead of like searching the answer yourself, AI native app just give you the answer directly by putting the information from the internet and summarize it well, right? AGIX is CoinShares Artificial Intelligence and Technology ETF, launched in July 18. Here's the ticker, like exchange, investment focus, right? Capture public listed global AI companies and potentially allocated private AI companies, investing in 3 areas: hardware, infrastructure, applications, with a proprietary AI exposure score to access the relevance and readiness for AI. So this is a great introduction, right? We have been seeing like very powerful growth of those AI applications and AI large language model recently, right? This industry is developing faster than ever. So now I'm going to turn it over to Solomon Beer and give an update on the latest trend in the AI industry.
Thanks so much. And it's great to be here. We're really excited about this next trend of AI. We think it's one of the next transformational transitions within the technology landscape. And we can kind of see that because we look at some of the growth for some of the companies in the AI space, such as ChatGPT, OpenAI, Claude, and their ability to scale has surpassed anything we've seen in the past. Every time we see a new technology trend, we tend to notice 2 things. Once initial traction surpasses prior waves traction. So for ChatGPT here, you see it took them only 2 months to get the 100 million users. That's an incredible growth in a short period of time. Second thing we look for is significant outperformance or misses in mega cap companies in the technology space. And we saw that with Nvidia, with a lot of the analysts missing some of that outperformance of Nvidia by a significant amount. However, one of the questions we ask is, even though ChatGPT is growing very quickly, is AI already losing steam? Has the trend already played out? And we would argue we're still in the early innings. And one of the things that we look at is generative AI user traffic. We see user traffic, despite growing very fast, is still in its infancy. ChatGPT still has a lot of penetration and ways to go. And in terms of usage compared to WhatsApp and YouTube, it's still a lot lower. So there's a lot of room for ChatGPT or Anthropic or other companies in the AI landscape to continue to grab time share from users in the space. You can go to the next slide. AI progress is developing at an incredibly fast rate. So we've been following the AI, at least me in my career, since the early 2010s when AlexNet came out. Before that, we had traditional AI, which was really the first breakthrough in the 90s, early 90s, late 1980s, when IBM created a chess bot that beat its grandmaster. At this point, there's been a few points where we really hit a ceiling, and it took some time to have the next breakthrough. At this point, really, we didn't have the concept of scaling laws with AlexNet, and there were some issues with the initialization of parameters that we didn't understand. So we couldn't set up machine learning models as effectively as we could in the 2012s. AlexNet was a breakthrough, and I remember when this paper came out. I think Nvidia at the time was about $3 to $5 a share, and AlexNet was developed by Ilya and Alex from 2 PhD researchers who really had the insight that its scaling is really the missing piece, and we needed a new paradigm for computation. So AlexNet can completely destroy the competition in the ImageNet competition, and it did so by moving from a CPU-based architecture to a GPU-based architecture, which was parallel. And that's a big deal because that's a completely different computational paradigm. And parallel computing traditionally was used mainly for graphics. At the time, the market still didn't really recognize this. Nvidia, for a while, was still trading pretty low. A lot of the analyst coverage was focused on Nvidia's Tegas model, which was their mobile chip that was competing, or mobile handset that was competing with some other mobile players at the time. And it was actually an activist target. If you go back to 2012 until really 2016, Nvidia as an AI play wasn't really very widely talked about. It would still take some time for this to disseminate within the startup ecosystem and technology ecosystem. At Cruise in 2015-16, we were aware of AlexNet, so we were using GPUs, but not to the level that Google was. And Google had built an internal TPU, or tensor processing system. In 2017, Google released a transformer architecture, which was the next breakthrough in the AI landscape. It's what a lot of you guys associate with ChatGPT. But even them, Google didn't recognize the power of what they had built. And in some ways, there was an innovator's dilemma. If they were to use some of this AI, it might hurt their existing business. So a lot of the researchers at Google left, some of them who are advisors for us, some of them who are at companies like OpenAI, Anthropic, and beyond. Um, from this Transformer release of 2022 is when the OpenAI team really worked on scaling and increasing the amount of data. And in 2022, the public release that maybe many of you has tested really was the breakthrough. And there was another release in 2021, 2020 for an earlier model, which we had tested. And we saw that the direction where this was heading. So the question is, have we hit a ceiling? And my argument would be, we typically hit these plateaus, and the plateaus can last a few years before the next breakthrough. But the breakthrough can be an order of magnitude more powerful. So imagine an order of magnitude more powerful breakthrough than the transformer model than what you're using right now. So we're really excited. We think it's very hard to predict, which is why we want a lot of exposure now for the next at least 5 to 10 years as we continue to innovate in the AI landscape. You can go to the next slide. As I mentioned, AI really represents the next wave. So we've broken down the waves into 4 main sectors: the mainframe revolution, right? The PC server revolution, the cloud and mobile revolution, and the AI revolution. In each of these revolutions started with companies that would become generational leaders that weren't necessarily represented in the main technology indexes, not because the technology indexes didn't include them, but because they were market cap weighted and these companies were growing, so they were smaller. So in each of these technology cycles, you had something that would completely break the prior paradigm, that would require a lot of capex at the infrastructure layer, a lot of capex at the platform layer, and the complete rewriting of software. The PC server era completely redefined some of the operating systems, how we compile programs between multiple architectures. The cloud and mobile boom completely changed how we also deliver applications. We had mobile native applications. We also had the cloud boom. So we had software being delivered as software as a service. Each of these booms created new companies and new ways to underwrite these companies. In the 1980s to 2000s, we were not using the rule of 40 or SaaS-based multiples to really underwrite it like we would in the cloud mobile era. So for each of these waves, there's a generation of companies that capture the large market share. They aren't necessarily represented in the main technology indexes or ETFs, although they eventually over time will be. Right now, they aren't. And there needs to be new ways of underwriting or new rules to capture a lot of the paradigms or a lot of the changes that maybe didn't apply to the prior generation. And that's really what we're trying to capture here, is a way to have an ETF that captures the AI boom, that does so in a way that's relevant for this AI, but maybe a rules index that maybe didn't work for the cloud or mobile boom, right? And for us, we think this wave for the next 10 years will capture a minimum of 250 billion to 1 trillion in asset value. And we come up with that because for each of these S curves, we've seen that there's at least 250 billion in market cap created if you go through these companies in the first 4 to 5 years. You can go to the next slide. So the market recognizes the potential of these AI leaders. So Nvidia is up already over 900%. We see Microsoft, Meta, and Google up, and the Nasdaq up 163%. But if you were maybe equal cap market or market weighted based off the past, you would have underperformed compared to the more technology focused ETF. You can go to the next slide. Despite this outperformance, and I think this is a very common question, is AI expensive now? We would argue it's maybe compared to the dot-com bubble is an example that's brought up. Like, well, the dot-com bubble got very expensive, capex became very high very quickly, and then there was a crash. We would argue, at least comparatively, we're not quite at the level that we were at the dot-com. And while valuations may be elevated, and may see some short-term corrections, they're not quite at the level that they were in the 2000s. In 1999, Cisco reached a forward PE multiple of 156. There is no universe where that is going to work out into a good investment, no matter how strong the technology trend is. Right now, Nvidia, which is one of the most expensive forward multiples within the mega cap technology stocks, it's sitting at a multiple of 46. So it's expensive, but it's not nearly as expensive as it was in the internet boom. And the other Mag 7 stocks are trading somewhere between 30 to 20. And depending on what time you're watching this webinar, if it's recorded, that might change because they're always changing. But they're not quite as expensive as we've seen in the dot-com bubble. And we still think on a longer term horizon, even if there's short-term corrections, that over the next 10 to 15 years, an exposure to the AI landscape will really continue to outperform because we need to reinvest in everything within the technology landscape. We need to completely rebuild our GPU data centers to handle GPUs, including liquid cooling. We need to come up with completely new ways to do data storage and networking. And we need to come up with complete new paradigm for application software and maybe move to a usage-based model. So everything, there needs to be a complete reinvestment to accommodate this transition. So for over a long-term time horizon, even if there are short-term fluctuations, given capital cyclicality, capital cycles, we're very optimistic. You go to the next slide. I think we've spoken a little bit about this, that a lot of the AI performance has been concentrated in the top tech companies. This is both on an AI factor basis and as a market cap weighted basis. And this makes sense. These companies are already a large percentage of the ETF or of the market cap weighting. So if you remove the Magnificent Seven without Nvidia, you underperform by about 11 percentage points. You can see Nvidia is clearly the leader. Meta, with its ads-based Llama business model, has also outperformed. And you see companies that maybe are at risk. Google, while there's definitely some advantages for AI, has some maybe short-term innovation dilemmas. And you can see it didn't perform maybe at the levels of those with AI exposure. So our goal is to really come up with a rule to capture this AI exposure, not just at the mega cap level, but even at the smaller cap companies level as well. You can go to the next slide. So we really look at a broad universe. So we are looking at everything within the infrastructure stack, everything from semis to data centers, to edge AI and networking, to model companies, to cloud companies and application companies. Some of these have been companies that we've looked at investing in personally. And some of these are companies that we follow in the public markets. Our goal is to try to have an ETF that captures the full stack, as well as potentially having access to some private companies that might not show up in a traditional public tech ETF. Within the semi space, we're looking for companies that are dominant market leaders, that have high pricing power, that's R&D is competitive and continues to reinvest in the future and reinvest in new architecture. It captures a lot of the initial infrastructure spent within the AI infrastructure build out. With the data center space, we're looking for companies that a large percentage of their revenues are focused on new GPU data centers, not just traditional CPU data centers. So the things providing racks and server appliances or liquid cooling. We're also looking at companies that are focused on edge AI. So think chips or computation that can fit AI models within devices or add networking that can fit within, that can allow to make devices more efficient running AI or connecting to the cloud. We're also looking at traditional model companies, companies that develop the next generation of large language models that are going to be powering the applications that you use, like an OpenAI or an XAI or an Anthropic. We also look at the traditional cloud companies, everything from security, traditional infrastructure or platform as a service, companies that offer maybe new storage solutions that are more optimized for parallel computation, or companies that offer cloud infrastructure that supports AI workloads, and applications that really build on top of AI, that think applications that you could use. So you don't need to take an API and build your own software. And we would argue that the application layer, which tends to, in the prior cycle, could capture, and according to Bain in the last cloud boom, about 60% of the value accrued to just the application layer. Many of these companies have barely been founded or have just been founded. So we think it's very early, and we want to have access to companies in both the public markets and even privates that have a, a big tailwind from the developing AI native applications. And we think there are some existing industries where they're legacy companies, but they're adding AI applications, and AI revenue is increasing because they're adding maybe an offering and adding an AI product for $10 to $20. So average revenue per user goes up incrementally. The cost is not that high for these companies, and it's pure accretive free cash flow for these companies. Next slide. So these opportunities are really multifaceted. So right now, they're really rely predominantly on hardware, infrastructure, or application. As you mentioned, so within the hardware, we're looking within the semiconductor space, and we have our rules-based index to capture things like within the semiconductor space, design, manufacturing, and packing, as well as within the hardware space, networking, cooling, and power. And we're seeing about, according to Nvidia's annual review, data center revenues alone rose 217% to a record 47.5 billion. You're going to want exposure to the increased tailwind from this movement. Within the infrastructure layer, this includes everything from data preparation and computational infrastructure, as well as model deployment, so cloud and security and storage. So if you listen to some of the larger mega cap companies like Microsoft, so the cloud model Azure Arc is now used by 33,000 companies. That's a 2x growth in a single year. At the enterprise level, a 100% year-over-year growth is almost unheard of. That's what we look for in the startup landscape. So there's clearly incredible adoption and clearly in the early innings, and we want to capture that. Within the AI application space, we're looking for AI applications that are developed for sales and marketing, enterprise software as a service, tech and coding, financial, entertainment, and healthcare. And these are really companies that can be some of the most cash flow positive in this entire ecosystem. So I think we looked at Meta's call, and they estimated that the capex for AI is going to range anywhere from 35 to 40 billion dollars. That's an incredible amount of capex to be building the next generation of AI. And we think a lot of companies are really racing to retool their software to come up with applications that hit all these verticals and give customers a really great experience that's AI native. Go to the next slide. We're going to double click on the AI hardware. So AI hardware includes specialized chips like GPU, as we spoke about. It also includes specific hardware to allow rapid trainings of models. So if we look at the single chip inference performance, it's up 1,000x in 10 years, from an FP32 to INT8 to the H100s. We've seen incredible deployment. And when we follow this trend and we listen to Nvidia, we think the performance will continue and it will follow a Moore's laws type performance. The Nvidia CEO on a call said that predicts that $1 trillion will be spent over the next 4 years just upgrading data centers to support AI investments. If you look at the last cloud boom, where we also needed to spend a lot on data centers, traditional CPU data centers, this is 4 times the capex spent than we spent on the last cloud infrastructure boom. And if you had invested in the cloud boom in the last cycle, you would have significantly outperformed the generic tech ETF. We think the same will happen here. Within a recent report, I think Stanford had noted that GPU performance had increased 7 times since 2003. But the more important metric that we also track is price per performance, which is 5,000 times greater. So we expect these chips to get more powerful, but also more cost effective, which makes it easier for application companies to develop their AI native applications. So if we're actually outpacing Moore's law, which was developed by one of the Intel principals, which is currently outpacing it by about 3x right now, which is pretty incredible. So AI hardware is going to continue to be an area of innovation, an area where there'll be a significant amount of capital expenditure and a significant amount of value accrued, especially within the next 5 to 7 years in the early infrastructure build out. You can go to the next slide. For AI application to scale, its infrastructure must also be ready. I'm sure a lot of you have used ChatGPT or Claude or other applications and been frustrated when they've run out of compute or they've had to throttle you or tell you, sorry, the service isn't working. That's because the infrastructure has been significantly underinvested because many companies did not expect this level or did not see this trend coming. So LLMs need to come up with ways and tools to build, deploy, and maintain applications. Within the cloud infrastructure layer, we need to be able to provide flexible foundations that are necessary for AI workloads. Within the data infrastructure space, we also need frameworks that support the collection, storage, processing, and analysis of data. And within the security infrastructure, we need things that integrate with AI systems to ensure the integrity, confidentiality, and availability of data. So AI infrastructure encompasses all these things, and many of these things are still being iterated and built right now. And many of these existing companies that provide these solutions for traditional CPU cloud-based solutions are currently working or going to be capturing some of the solutions for the next wave for AI infrastructure. Go to the next slide. So AI infrastructure companies capture a really large share of profits right now. So of the landscape that we've discussed, I know many of you think of Nvidia when you think of AI. That's pretty accurate right now. You see that 43%, $43, so 75% of the subscription cost of your chat GPT flows to infrastructure right now. We think that will change over time, and we think those costs will come down, which will be good for application companies. And we can follow the gross margins. And these are things that we study, and we try to capture all this within our rule-based index. So within the model infrastructure company layer, we generally see about $32 gross margin, and the cloud infrastructure is about a 43% gross margin. So for every $100 on AI spending, you see with an application layer right now, application gross margin is low. So if you just relied on this for your future index-based ruling, you might miss some of the shift to application outperformance as the infrastructure becomes more computationally efficient, as we showed in the last slide. You can go to the next slide. And for our last slide, if we want to talk about the application layer, we'll double click on the industries that are working on AI specifically within applications beyond just the infrastructure layer, which many are familiar with. Generative AI really touches all industries, and we're seeing this across so many public company calls. I think it was maybe Walmart today who had a call and mentioned generative AI and how effective it has been for them. So we're seeing it everywhere from media and design. So these are private companies like Suno and Runway, Midjourney and Pika that are creating new ways for creators to develop music and video and pictures and images, which makes these creators more efficient and create new ways of creating content. Within public companies like Adobe and Meta, they're integrating this into Instagram or their Adobe Photoshop editor tools, ways to edit your pictures or your videos. These are all net new products that don't exist currently. This is what we consider the easy on the left-hand side, it's easier adoption. Within the enterprise SaaS market, we're seeing companies like Cursor, which help for AI code development, ServiceNow, Workday, or Monday, which are all different enterprise companies that are offering different products within the AI landscape that are integrating AI within their product. So maybe Monday, a CRM is integrating ways to auto send emails and auto write emails and auto triage tickets and triage your Kanban board to make companies more efficient. And they offer this as an add-on service, maybe for $10. Purely incremental profit for these companies. We're looking at companies like Cognition and Replicate, which offer automated AI coding assistance beyond just an coding in IDE like Cursor. And within the sales and marketing space, we're also seeing a ton of innovation, like private companies like HeyGen and Bland AI, where they're really developing avatars for learning development or sales and marketing, or AI agents that are able to, customer support agents that are able to listen and respond to users as if it's a normal human, saving companies an enormous amount of cost. We're seeing companies like HubSpot and Salesforce integrating AI into its Einstein AI platform to auto write emails, auto respond to emails, auto create templates. And these are being added as, again, add-on services that are immediately incrementally free cash flow positive. We're looking at companies within the accounting and finance space, which is very new. Companies like Hebbia, which are offering a new operating system for finance companies to help underwrite companies within Excel, to help underwrite and review data rooms and come up with new financial models and do so something that an analyst might have taken a week to do, they might do in 30 minutes to a minute. It's incredible. We're looking at companies like Intuit and S&P to integrate AI into their existing offerings, Intuit to help individuals optimize their spend and to triage things like receipts and invoices. When the education, we're seeing some disruption as well. We're seeing companies like Duolingo and Luently offering completely AI native tutors for students, where traditionally they may have gone to a Kumon or a traditional brick and mortar tutor. They now have a one-on-one AI tutor that they have a personal connection with and that they're able to learn from, as opposed to just a bunch of studying at like with pen and paper. So it's a much more personal experience, and they're seeing higher engagement. When the gaming, we're seeing AI generated NPCs, especially by companies like InWorld, or AI chatbots like Character AI. With the healthcare lines and life science space and manufacturing spaces to the furthest along, healthcare and science, we're seeing things such as new drug discovery companies. And with the manufacturing space, we're seeing things like robotics companies that have a completely new foundational models where they can handle all tasks like a human can, where you don't need to program in or give it a complete rule-based instructions. It can learn from its environment. And that's a completely different paradigm shift, but much further along. So these are the things that we're studying within the AI application layer, and we expect or hope the ETF will capture a lot of this wave, and that covers a lot of the landscape within the AI. And I'll turn it over to Max to talk more about the rule-based index.
Thank you. So, all right. So we have been discussing and explaining why artificial intelligence is a trend and here to stay, but how the product AGIX relevant as an investment opportunity in capturing the value, especially the value creation. So even though this technology is still just getting started, we are really confident that it's going to create a lot of big winners while leaving others behind. So investing in winners is important for sure, and avoiding losers is even more so. So by avoiding companies that has high chances of getting disrupted, you will excuse yourself kind of from investing in Motorola while iPhone strikes the market a decade ago. So that's where AGIX comes in. So it offers a well-rounded way to getting exposure to both public and private companies that are benefiting and thriving because of AI, and also identify headwinds ahead of curve, given our research capabilities in the private market as well. So basically, the ETF will follow the performance of the index called AGIX as well, a process-driven methodology that combines the traditional market cap weighted strategy employed by the Nasdaq 100, and also the AI readiness and relevance screening driven by our fundamental research. So our process starts with market cap and industry screening. We filter companies based on the market cap of 2 billion and above to ensure the meaningful coverage of major players with enough liquidity and also volatility and control. Next, we focus on the industries that are actively engaging in AI development and adoption. According to the fact set of industry definition, we identify 12 key sectors, such as semiconductor for sure, data processing services, and internet software and services. So industries like oil and gas and home building, which don't align with AI initiatives, are excluded. So this will help us refine our list to around 300 to 400 companies that are truly relevant to the AI wave. And thirdly, we assess each company's AI readiness and relevance with our proprietary AI exposure score, which range from 1 to 5. So this score is derived from a combination of companies' public filings and also our fundamental research. For example, companies like Microsoft will receive a higher score as it actually has an AI product like Microsoft Copilot already generating revenue. Yet we still looking several steps ahead, also giving companies like Palantir higher score as AI will transform its business and supercharge its growth. But interestingly, even the most aggressive adopters in AI currently, we are seeing less than 5% of their revenue coming from AI. So this contrasts sharply with 30%, 50%, or even 100% that many investors expect. This actually highlights that we are still in the early stage of AI integration. So the AI enablers and adopters that are going to capture the ballpark of the growth will extend way beyond Nvidia of today. And we are about to see the 40, 50 companies that are already included in our index. It's going to expand their AI revenue while more companies join in force so that we can pick the very best of them. So with the AI score with the market cap, we apply those two dimensions simultaneously in a weighting process to capture both the momentum of large cap companies while reflecting the delta that AI brings to its growth. So each quarter, we balance our portfolio based on new insights from earnings calls, from business development of the portfolio, and also the broader market trend. So this ongoing adjustment helps us rewarding the winners in accordance with their AI progress, while downplaying or eventually removing the underperformers. So ensuring that our portfolio remains relevant to the landscape change of AI technology. So basically, we consider AGIX to be an AI version of NASDAQ 100, capturing the growth and momentum of the winners and also avoiding losers. Next page, please. So let's dive deeper into the scoring system. It's pretty cool because it perceives and evaluates public companies from 4 different angles. The idea is to gauge how strong they are in AI, both now and in the future. So the first thing we look is what we call AI relevance. So it's basically asking, does this company actually have its own AI product right now? And if they do, how much money is it generating? Take Nvidia, for example. They've got those H100, GB200 chips, so they are scoring pretty high. But then you've got Apple, who before the announcement of Apple Intelligence would have scored really low under this dimension because they haven't shown what they really could do with AI. And next is AI readiness. So this is more about looking ahead. We're thinking, okay, AI is going to change everything, right? So is this company set up for it, set up to make money from it in the future? And if so, how big could it be? So Adobe is a great example here. If they can, slap AI Copilot or, develop a voice agent on top of their software, it could make their complicated yet powerful software super easy to use. So that could be huge for them. So with all those 4 angles, we can adjust scores whenever a company makes progress in AI. It's like giving them credit for their AI moves, but we're not just chasing the latest AI hype. So this system will take their long-term potential into consideration with a kind of smart and forward-looking scoring system. Next slide, please. So based on the systematic approach of screening and evaluating, we have a quite concentrated bet that goes beyond Nvidia to market leaders in AI hardware, AI infrastructure, and AI applications. So our top 10 holdings now make up almost half of the entire portfolio. Take TSMC and SML, for example. So these companies are absolutely dominating their domains and have incredible pricing power. And then there's Meta, which is positioned well to become one of the dominant applications for their massive distribution ecosystem. But here's the mind-blowing part. When you look at the growth of the top 10 holdings, it's just astonishing to see that they are having 100% EBITDA growth compared to the 3-year average 27%. So this means that these companies are accelerating their growth even at their current size, which is obviously a testament to the transformative power of AI. Next page, please. So one more thing worth mentioning is we design a system in order to reflect the ever-changing nature of the technology. So the weighting is not fixed. It's not only fine-tuned by our AI exposure score, but also adjusted at a sector layer. So each sector capped at 40%, yet subject to change based on the involvement of the landscape. So if we look back in history, like companies that are developing or manufacturing hardwares always rise first. And then we have infrastructure companies that use the hardware to develop a platform and essentially lower the barrier of entry and also lower the cost. And then finally, we have companies leveraging what have been built by infrastructure and hardware companies and to actually develop new business models and new products. Yet all this evolution needs time to roll out. So you don't want to be over-investing in applications before the hardware or infrastructure is ready. So therefore, our sector allocation ensures that the weight or the allocation going in the right bucket at the right time. Next page, please. But doesn't everyone already have a bit of those names like Microsoft, Nvidia of the world, if not too much? Why investing in AGIX to have additional exposure to the same names? So one reason we see is completeness. So like we discussed, the opportunities will extend way beyond big names, and the rest 30 names in the public part of the ETF actually offers better elasticity with the diffusion of AI. So companies like ServiceNow building its AI product, NowSys, have been the fastest growing product ever in its history. And Palantir, that using generative AI in its business intelligence analysis platform, it accelerated their revenue of 55% year on year. It's a rising star. So we will continue to see such development often overlooked by investors, but captured by our ETF, which instantly rewarded by the market after earnings calls. So also we have a private part of the ETF, also provides a unique opportunity that no one offers on the market that allow the investors to have the exposure in names like Perplexity, Anthropic, or other future winners. It also allows the investors to own some shares of their favorite AI applications. So the second reason is precision, especially during times when technology landscape is changing at a fast pace. So legacy companies, like Sol mentioned, need time to fade away. They may, struggle to keep pace of the AI revolution, yet given their previous success, they are still included in the legacy indexes. While if you look at NASDAQ 100, thinking that you are betting on tech, you're actually investing only 60% of the money in tech, among which might not all be beneficial of AI, but also maybe Pepsi as well, which is irrelevant to AI. Derek?
All right. Thank you, Sol and Max, for the introduction. I'll go to the next page. Here's the kind of like brief introduction of the fund. So we know AI is real, right? We're just beginning of this mega trend, right? This could be the biggest transformational technology in the world today, right? With companies building out the AI capabilities, enablers and adopters could dynamically capture the value over time. We believe investors need a holistic and systematic solution to capture the long-term investment opportunity from the transformation power of AI. So AGIX AI score framework could be crucial to identify winners and losers from the AI disruption. AGIX offers a solution to invest in over 40 AI-related companies beyond Max 7, right? For more information, please visit CoinShares.com/AGIX. Right, I'm gonna now going through some disclaimer and starting the Q&A session. Just wanna remind you again, if you have any question, please submit your question to the Q&A session below. If you join via Zoom, if you're watching through CoinShares.com, please send your question to info@CoinShares.com. I think we're to get some questions here. So first question, are you considering to include energy company those may be able to supply energy to be consumed by the AGI companies? Anyone wanna answer that question?
Yeah, I could go first. So we have seen some energy, names popping up on the market and rewarded by market because of shortage of energy, obviously. But in our view, that in the long run, the energy sector is less elastic and less relevant to the current AI development. So we'd rather put our allocation more into the more adjacent sectors rather than energy for now. But if we, continue to see AI being applied to the energy sector and revolutionize the AI, and the energy sector, we could also include some of the names in it as well. But by then, we will consider the energy sector will be one subsector of AI application instead of the, because of the current shortage of the energy for the AI training.
Yeah, we just heard from the Nvidia that its latest Blackwell infrastructure can actually save 25x the energy costs, or like the kind of like a performance like 25x faster, right? So it's like as those technology breakthrough, they could be very cost efficient or like energy efficient solutions coming out in the later stage. So next questions. So do you have any concerns about fast growth and capacity constraint with the companies in the industry or portfolios? So yeah, like capacity constraints. I think that's the key for this question.
Yeah. So I think capacity constraints can mean a lot of things. It can mean constraints on the infrastructure built out. It can mean constraints on the ability to deliver applications like AI applications to customers. I think for us, the reflection of capacity constraints is a reflection of the underinvestments in the space. So it's a reflection that we're still in the early innings and we need to invest in an incredible amount. Capital cycles are always difficult to predict. There can be underinvestment and overinvestment, but over the long period of time, there tends to be equilibrium and tends to be accretive to investors. So the capacity constraint to us solves like something that we're typically concerned about with more deep tech frontier research. Is there product market fit? And there is here. So if there's really product market fit and customer demands, the capital markets will work out the rest. And that's really our belief.
All right, I have many questions coming. We mentioned about like the public and private. So the question is like for the private, what's the percentage of, and at what stage we're like investing in the private? So currently we just launched the fund. So I think the target is to investing maybe 5 to 10% in the private when we're reaching like certain level of asset for the fund. And it can go up to 15% as a maximum allocation to the private, right? And next question is, are you planning to include some China tech that have AI exposure? So like for investor who's familiar with CoinShares, we do have a China Internet ETF called KWEB that capture a lot of China AI exposure. So for this fund is majority US companies. So to offer more like US focused artificial intelligence opportunities, right? So next question, how does the private investment component work? What are the first targets? Like, yeah.
I'm not sure we can give specific targets, but I think it's companies that have big tailwinds from the AI landscape. Yeah, so I think that's all. I don't know if we can say anything more on the specific targets, but it should be companies that are really generational companies that you guys really probably either you personally use or love, and companies that are really the biggest beneficiaries in the AI landscape.
Okay, next question. So there's massive investment in AI hardware, right? Nvidia CEO project over $1 trillion to be investing in AI data centers. And the debate now is whether those investments will pay off, right? What do you guys think about that question?
Yeah, I think it really depends on, sorry. I think it really depends on how transformative this technology is. So if we are building like intelligence that are so generalizable that, could automate a vast amount of human effort. So we are talking about innovation that is even larger than the Industrial Revolution. So if we take railway investment as an example, it used to occupy like 15 to 18% of GDP back then. But right now the AI capex is only about less than 2-3% of US GDP. So we are still early in terms of scale of the investment. But what really puzzles investors are who should be investing in the AI infrastructure. Should it be private sector or should it be government? So I tend to agree with what Jensen Huang said about the sovereign AI. So we are about to see this paradigm shift from private sector burdening those capex to public sector investors. So what I really try to say here is, we don't think it will not pay off. We're about to witness the applications catching up, and the investment of the AI capex will intensify among different kind of participants.
So next question, what is coming for large language models? What could be the next ChatGPT moment?
Yeah, so we look at a lot of private companies, including companies that maybe you guys have seen that have spun out from even OpenAI and others. I think if you remember the slide where we talked about AlexNet to large language model, the breakthroughs are non-linear. So we think there will be a breakthrough, and we think their potential will move beyond the transformer model. But as investors, we're not trying to guess that exact architecture. We just have confidence that there will be continued breakthroughs. And if you look at the breakthroughs that we had at this point, the investment in AI research was still not a large component of CapEx, and we got the transformer model. Most people were not that interested in deep AI research, the average PhD researcher, compared to now. So imagine what we got in 2017 to now, right, with a small percentage of CapEx being dedicated to AI versus a large percentage increase in AI CapEx now. So we think we'll see models that are more efficient, more cost efficient, that are more intelligent, and that can handle multi-step reasoning. Those are really the next paths. And I think for a lot of you, maybe you guys really like using the current AI applications, but maybe it fails on certain tasks. But if you watch those tests, a lot of those tasks tend to be multi-step problems, like do A, B, and C for me. And that level of reasoning is where we think the next form of AI will go. And the other ones is things deeper level of AI models for videos. So AI videos in the early stage, we did some computation that AI videos are gonna like use 2 orders of magnitude more compute than generating AI images. So that it's another tailwind for AI infrastructure capex.
All right. So next question, is AGIX a global fund or just US companies? In the long term, could global companies benefit from AI? Since US market is already pricing a lot of AI rise. So, I mean, we are a global fund, but like US is like, I think over 80% of the portfolio. In
Yeah.
terms of like the global like peers, like anyone want to answer that question?
Yeah, I think right now mostly U.S. stocks, but we also have companies from Korea and Japan and other regions that are benefiting from the current AI wave. Could be the supply chain of semiconductor, could be anything that's in the new AI factory, which means the GPU data centers that are benefiting from current AI wave.
Okay. Next question. How much of Nvidia and others' revenue is representative of one-time capex?
For Nvidia?
Yeah.
Nvidia.
Yeah.
I think so within the capital cycles, there's always maybe an upfront capex and it levels off. So it's impossible to predict that. But even if you looked at Intel, the CPU-based architecture, right, they're consistently more efficient CPU-based architecture. So data centers were retooled, were replaced with newer architecture. So the AI is not just about training models, it's also about inference. So a lot of future capex can shift to inference. And if you look at some of our research, we've posted that AI inference, especially as you transition to more computationally expensive models, can actually overtake the cost of training. Diffusion models like Stable Diffusion and some of the video models, Inference and Midjourney, as an example of companies, spend more on inference than they do on training. That's the opposite of ChatGPT right now. So I think the reflection or the assumption that AI is just a one-time capex to get the models and that we're done is a reflection of LLMs were the first pieces of AI that actually were adopted. But there's a lot that you guys haven't even used yet because it's not production ready that costs more on the inference side. So to answer your question, inference we think will take the rest of the demand. So we don't see it being a one time.
All right. We have two questions that's similar. So of the different categories in AGIX, do you allocate different percentage to different category? And do we have a plan to like revise the way companies within AGIX?
Yeah, currently we have 3 sectors: AI hardware, AI infrastructure, and AI applications. So we have a cap for each sector at 40%. So right now the allocation will be 40% in AI semiconductor, AI hardware, and 40% in AI application, and 20% 40% in AI infra and 20% in AI application. The reason why, because we normally if you look back in the history, normally the hardware companies rise first, right? And then the infrastructure and building a lot of platforms that lower the barriers of entry and lower the cost of using the technology. And then finally, we have applications that building new business models that capture the largest pie in the end. So it's kind of a dynamic process. But right now, we obviously are still in the early stage of hardware building and infrastructure and capex. So that's why we allocate 40% in the first 2 sectors and only 20% in AI applications. But given time, if we see that the model is already kind of stabilized, we don't have GPT-10 or GPT-12 going on every year, and then it's a time for the AI applications really shine. So by then we are going to increase the percentage of AI applications from 20% to even 40%, and then lower the percentage in the hardware and infrastructure.
All right. Next question. Why should investor considering investing AGIX compared to like NASDAQ or other tech index ETF?
Yeah, that's a great question. I think traditional tech ETFs are market cap weighted. So they're based off the current paradigm where technology companies currently make money. In the future AI transformation, a lot of these companies will be generating new AI revenue streams, and that's not captured by the index. In 20 years, when AI becomes mature, the AI ETFs and tech QQQ should converge. but we're not there yet right now. So this would be like not investing in Apple in the early days. Right now, Apple is a large percentage of the index, but it wasn't, and you would have outperformed the index. So if you believe AI will be the dominant driver of returns within the technology landscapes, then an AI-focused ETF should really capture or outperform a technology-focused ETF, and that's really the assumptions that we're making.
Okay, what are your thoughts on open source large language models? What's the future of LLM?
So that's a great question. I think as an ETF, we don't have to make singular bets like that, which is nice. So you have a broad exposure and it reweights. So if open source companies end up winning, you'll get exposure to that. So our answers maybe are less important to the ETF's return as personal opinion, but we think open source and closed source, at least right now, will provide two different capabilities, because we kind of see this even within the traditional open source model where you have a Red Hat or a MongoDB where they have a freemium model for companies. And we just had an event with Anthropic last week, and a lot of enterprises came and they said, like, we need handholding, we need help with fine tuning. We don't have the resources. We have access to off the shelf a Llama model, but we need help with prompt querying and caching and things that maybe an open source library by itself doesn't provide. So we see open source filling a gap within the more technology focused, like developer focused companies who are technical. And for the largest companies with large budgets, who maybe ironically are less technological savvy, closed source models which have frontier capabilities will fill a role. So we see a role for both, at least in the short to near term.
And also in terms of portfolio, you also have like holistic exposure of the open source and also the closed source. You have Meta here, you have Google in the portfolio. In the future, maybe we also include some of the foundation model companies in the private part as well.
All right, we have an investor from UK asked, like, can I invest in the ETF in UK? Well, I was just like, please ask your financial advisor or your broker. So this fund is listed in the NASDAQ in the US. So for any investors like globally, I think if you can trade ETF in the NASDAQ, please ask your broker and financial advisors. Then next question, how do you view the effort to solve the black box, white box problem or lack of visibility into the base of AI generated results and ability to error correct it? Right?
So I think, yeah, that's a good question. I think for us right now, we talk to a lot of companies like Anthropic and OpenAI that do interpretability research. So they're working on that. And they're offering a lot of this research publicly. So you should go to their Twitters or their blogs and they're posting it. Yeah, it's an area of research for us. We think right now AI is still generally useful for a lot of people, maybe in the audience, even if it's not 100% accurate and sometimes it gets confused. It's still very useful on a weekly and daily basis. Now imagine if we can solve this black box problem. It just makes the AI adoption even stronger. So there is research being done into it, and all these problems that get solved just make AI easier to use, more efficient for you, and more accretive to investors who are early investors in the cycle.
All right, next question from Israel Salinas. Do you have any plans for direct exposure to quantum computing companies?
Max, you can answer.
Yeah, I think that's a very great question. I think for now we are only looking at like the AI support system that we have. We are looking at companies that are actually has AI product right now and actually has AI contributing in their revenue. So we haven't seen any potential target that fits into criteria in the quantum computing space. But if we do, we would like to evaluate the company further and consider to be included in the index in the future.
So we have a question. Is there anything in the AI model to account for profit? For companies like Super Macro, the profit may be high now, but there's low entry or barrel. So we'll attract some competitors and lower profit in the future.
Yeah, Max, you talk about the index and how they handle that.
Yeah, I think for profitability of those underlying portfolio companies, we take less consideration at the moment because we think right now it's still in the early innings of the technology, and also if you really look at the the financial status of the portfolio companies, they are quite strong. Few of them actually are losing money. A lot of them have like net cash flow and free cash flow. So basically, that's our criteria of selecting all those companies in the first place. And then we look at their AI progress and AI relevance and readiness, right? So Supermicro, although their market space or their like position on the market is not as strong as Nvidia and ASML or TSMC, who has a dominating place and pricing power, but still they are a crucial place. They occupy a crucial place in the value chain system of the current AI semiconductor and infrastructure. So that's why we also include Supermicro in our index.
All right. I think next question is, have you identified other public investment vehicles and what is your differentiation, right? So compare, I mean, maybe compare other competitor products in the market.
Yeah, I think right now, if you look at other AI ETFs on the market, a lot of them launched way before ChatGPT launched. So actually, I mean, their composition or their constituents might not be representative of the current AI wave. And second, we consider our portfolio as a kind of AI exposure, comparing with NASDAQ 100, which only investing 60% in the technology, and also maybe among those 60%, not all will be beneficial of AI. And other like ETFs or AI ETFs, they may have like companies like eBay instead of the companies that are directly benefiting from the current AI wave. So that's the way how we position ourselves in the market space, being completeness and also offer a holistic exposure to the AI companies, no matter it's a public company or a private company.
All right, I think we're hitting the 12 time mark. It's the last question. So I'm watching your webinar right now. Could you send me a presentation deck and link for replay once it's available? Of course. So for investors who sign up and with this webinar, like you can actually watch the replay, and we're going to send the presentation later to the investor who have signed up for this webinar. So Max, I can't say enough thank you for today's discussion and very great insight on the artificial intelligence. And thank every investor to join today's discussion as well. Please, for any more information, please check greenshares.com/AGIX, and we can follow up on the emails at info@greenshares.com. Thank you everyone today for joining.
Thank you there.